The fourth largest Wall Street investment bank, Lehman Brothers, third ranked Merrill Lynch, Citigroup, and the world's largest insurer, AIG, were all caught in the crisis whirlpool, leaving the U.S. financial system teetering on the brink. In the second phase of the crisis, Bernanke's primary response was deploying the Fed's financial might to directly bail out too-big-to-fail institutions through capital injections. In Bernanke's theory, mass bank failures were the critical link that turned crisis into deflationary collapse. He was determined to prevent a repeat of the 1930s tragedy. When Bear Stearns faced imminent collapse, the Fed created a backstop loan model, first selecting willing institutions to bid through Fed-backed financing. The Fed chose J.P. Morgan Chase, providing $30 billion in special loans to acquire Bear Stearns' equity and assume its debts. At congressional hearings, Bernanke explained how Wall Street firms were interconnected through money market swaps and tri-party repos. Letting the fifth largest investment bank fail would inevitably create contagion, putting remaining financial giants at risk of systemic shutdown. The Fed later used this backstop model to support Bank of America's acquisition of Merrill Lynch and Wells Fargo's takeover of Wachovia. The Fed initially planned to support acquisitions of Lehman Brothers by Bank of America and Barclays, but their withdrawal left Wall Street's fourth largest investment bank. Lehman Brothers became the biggest casualty of the financial storm. AIG emerged as the biggest beneficiary of Fed rescues. The insurer received over $180 billion in public funds, 10% of total congressional and Fed bailout allocations. Yet in March 2009, with crisis ongoing, AIG paid $165 million in executive bonuses. Public outrage ignited fierce debates about moral hazard. Critics argued the Fed's interventions created new panic and targets for short sellers. Fed Governor Donald Cohn tactfully warned Bernanke, "Our aggressive bailouts fuel market speculation about hidden risks, with short sellers targeting Fed actions for new prey." When Citi attempted to acquire Wachovia under Bernanke's plan, market speculation about Citi's liquidity needs backfired. Their failed bid triggered commercial paper sell-offs. This chain reaction ultimately forced Citi itself to seek Fed rescue. This domino effect persisted until October 3, 2008, when Congress approved Paulson's $700 billion TARP program, essentially telling markets, "We'll cover all losses," finally deterring short sellers. The targeted institutional sell-offs finally subsided, marking the end of crisis phase 2. With this phase overcome, Bernanke turned to confront the third wave striking Wall Street's wholesale funding markets. This wholesale market is uniquely American. Post-Depression laws only insured deposits under $100,000, pushing excess funds into wholesale markets. These off-balance sheet operations, wealth management products, trust plans, formed the shadow banking system, invisible to auditors on formal balance sheets, hence called shadow banking. Non-bank financial institutions dominated this wholesale funding space. This market was vital for U.S. real economy financing. Industrial giants like GE and Boeing relied on its commercial paper market for liquidity, now collapsing. Vanishing market confidence left even GE struggling to sell debt instruments. SME financing became nearly impossible. Without intervention, this would devastate manufacturing and consumer spending, creating true Great Depression conditions. Bernanke launched two mechanisms. First, authorizing the New York Fed to directly purchase commercial paper, filling private capital voids to restore confidence. Second mechanism involved federal-funded guarantee programs to stabilize credit channels. Financial institutions originated nearly 3 million auto loans, 1 million student loans, 900,000 small business loans, 150,000 corporate loans, and millions of credit card loans. These mechanisms gradually restored wholesale market functionality. By May 2009, the financial system resumed normal operations. Now let's review the Fed's three-phase crisis response. We've covered the complete timeline. Here's the recap. Phase 1. Subprime crisis erupts. Institutions face collapse. The Fed deployed currency swaps, direct liquidity injections, and rate cuts. Three measures preventing panic spread. Phase 2. Crisis deepens. Wall Street giants falter. Fed bails out too big to fail institutions. Phase 3. Frozen wholesale markets require federal intervention. How is Bernanke's crisis response evaluated? We'll examine perspectives from Bernanke himself, economists, and Congress. Bernanke identified two crisis catalysts. One was deliberate tolerance of housing bubble by power centers. Two, fragmented regulation failing modern finance. Fed only overseeing banks while shadow banking grew unchecked. Complex interconnections through securities and swaps created systemic fragility. This created Western finance's inherent vulnerability. Bernanke believed the financial crisis didn't drag the real economy into prolonged depression, like the 1930s, precisely due to the Fed's aggressive interventions. This crisis strategy mirrored treating viral flu. First, economic stabilization through rate cuts and liquidity injections. Second, administering antibiotics to vital organs, rescuing too big to fail institutions. Finally, rehabilitating financial markets' circulatory functions. However, many economists questioned the Fed bailout's actual effectiveness. They argued neither Bear Stearns' rescue nor Lehman's collapse defined the crisis. Unlike 1930s panic, this was targeted short selling. Sophisticated hedge funds strategically attacked subprime exposed institutions. Other critics attacked bailouts, undermining market discipline. Capitalism without bankruptcy is like Christianity without hell. Unpunished risk-taking breeds moral hazard, requiring regulatory overhaul to prevent recurrence. Post-crisis, Congress initiated comprehensive financial reform. The Dodd-Frank Act established systemic risk monitoring through FSOC and consumer protection via CFPB. New agencies now oversee credit products and systemic risks. Previously unregulated OTC derivatives markets now fall under supervision, with the Fed overseeing bank holding companies over $50 billion, non-bank financial firms, and major insurers. However, lost bailout authority. Future failures of too big to fail institutions will face bankruptcy rather than Fed bailouts, with enhanced congressional oversight of Fed operations. The Dodd-Frank Act's constraints on Fed autonomy reflect public judgment on Bernanke's crisis actions. Now let's examine two issues crucial to current U.S. economic conditions. First, quantitative easing, QE, the Fed's post-crisis flagship policy. Over 6 years and 4 QE rounds, U.S. employment finally neared pre-crisis levels by Bernanke's 2014 departure. Globally, QE stabilized markets during Europe's debt crisis. Massive dollar injections prevented euro collapse. That the Fed's balance sheet ballooned from $900 billion to $4.5 trillion, 25% of U.S. GDP. Fortunately, banks held $2.4 trillion excess reserves rather than lending them out. For now, analysts fear unleashing these funds would trigger hyperinflation. Yellen's primary task upon becoming federal chair in 2014 was unwinding QE. Within 8 months of taking office, Yellen announced QE withdrawal. Second issue, Bernanke's adherence to new Keynesianism, stimulating growth through monetary easing. What's the actual efficacy of these policies? This question gains urgency amid global deleveraging calls. Mainstream economists view monetary-driven prosperity as illusory. Lawrence Summers, dubbed modern economics guru, posits superficially U.S. stagnation stems from successive bubble bursts. Root causes, stagnant labor growth and uncompetitive low-skilled workforce, these are beyond the Fed's monetary toolkit. QE preserved bank capital through helicopter money, but failed to uplift middle-class living standards, fueling Trump's protectionist rise. Powell represents hawkish anti-inflationary policymaking. Markets plunged 1,000 or more points post confirmation. Harsh welcome. Towel maintained rate hikes despite turbulence. Real growth requires innovation, not just liquidity. This concludes our analysis. Find show notes below. Until tomorrow.